For years, if you wanted to find the quietest, most predictable place in all of global finance, you'd look at Japan's bond market. It was the stable backbone. Well, that era just came to a screeching halt. Something just happened that sent a massive shockwave not just through Japan, but across the entire financial world. So let's break down what's going on and why it's a much bigger deal than you might think. Okay, let's start with a number. Just look at this, 4.2%. That is the brand new yield on Japan's 40-year government bonds. And to be clear, these things didn't just creep up. No, they surged past 4% for the very first time, all in a single day. For a country that built its entire modern economy on interest rates being near zero, this is nothing short of a financial earthquake. And you better believe the market felt it. One trader put it perfectly, calling the sell-off, and I quote, panic-level repositioning. This wasn't some minor tweak. This was a frantic head-for-the-hills scramble. Which leads to the big question, what on earth could cause this much panic in what was supposed to be the safest market in the world? So this surge is a huge deal for Japan, obviously, but why should the rest of us care? Well, here's why. Japan is the biggest foreign holder of U.S. debt. They own more of it than anyone. So when the financial ground starts shaking over there, you can bet we're all going to feel the tremors. Everything is connected. The big takeaway here is that this incredibly predictable foundation of cheap money flowing out of Japan, well, it's cracking, and the quietest place in finance just got very, very loud. So what was the trigger? You'd think, for a move this big, it would have to be some shocking economic data, right? An inflation surprise, maybe? Nope. The trigger wasn't economic at all. It was pure politics, delivered in a series of rapid-fire announcements that put every investor on the planet on high alert. It all started back in November. Prime Minister Taichi comes out with this massive $135 billion spending plan. Okay, big number. Then, in December, there's talk of suspending the sales tax on food. And then came the bombshell in January, a snap election, with the Prime Minister explicitly asking for a mandate to make a major policy change. Okay, so why did this string of announcements cause so much fear? Well, Japan's government debt is already just astronomical. We're talking somewhere between 200 and 250% of its entire economy. Now, that was kind of manageable when the cost to borrow money was basically zero. But when yields start rising, the entire math changes. The cost just to pay the interest on that debt explodes. So when the Prime Minister asks for a mandate for major policy change, investors hear one thing: a whole lot more spending is on the way, and they started to wonder who's going to pay for it all. But here's the thing. This political drama doesn't just stay in Japan. It spreads globally. And it spreads through this incredibly powerful financial engine that's been propping up markets for years, something called the yen carry trade. If you want to understand the global ripple effect, you have to understand this. So what the heck is the yen carry trade? It's actually a pretty simple idea. For years, big global investors have been borrowing mountains of money in Japanese yen because interest rates there were basically zero. And then they take that money and invest it anywhere else in the world that pays a higher return. Think U.S. government bonds, stocks, you name it. It's a simple four-step recipe. Step 1, borrow yen for next to nothing. Step 2, swap it for U.S. dollars. Step 3, buy something like a U.S. Treasury bond that pays you a decent interest rate. And Step 4, you just sit back and collect the difference. For decades, this has been a gigantic fire hose of money for assets all over the world. And the whole thing was built on one single assumption, that Japanese interest rates would stay at zero forever. Which leads us to the critical, multi-trillion-dollar question that the entire financial system is now facing. What happens when Japanese interest rates don't stay at zero? Well, the entire incentive just flips on its head. The whole game changes. I mean, think about it. Why would you bother with the risk of borrowing in yen to invest your money halfway around the world when you can suddenly earn a decent, safe return right at home? You wouldn't. So investors start selling their foreign stuff and bringing all that money back home to Japan. And this isn't just a theory. We saw it happen in real time. On the exact same day that Japanese 40-year yields blew past 4%, the yield on U.S. 30-year bonds jumped to 4.9%, which was its highest level in months. That is not a coincidence. That is a direct result of the world's biggest lender starting to bring its money home. So all of this puts the Bank of Japan, the country's central bank, in a truly impossible situation. They are stuck between a rock and a very, very hard place, where every single path forward looks painful. They really only have two main options, and neither is good. On the one hand, they could intervene, step in and try to force these bond yields back down. But to do that, they'd have to print a ton of money, which would risk crushing the value of the yen and destroying their own credibility. Okay, so what about option two? Do nothing. Just let the market do its thing. Well, that risks letting the volatility spiral completely out of control, which doesn't just threaten Japan, it threatens the stability of the entire global financial system. There are simply no good choices. All right, let's zoom out and connect all the dots. Let's talk about why this drama in a market halfway across the world really matters to all of us, no matter where we live. There's a great analogy for this that I think explains it perfectly. Higher long-term bond yields act like gravity on riskier assets. Think about it. When you can get a pretty good, safe return from a government bond, it suddenly makes riskier things, like stocks, look a lot less attractive. It literally pulls their value down. And this new, stronger financial gravity pulls on everything. It makes stocks less attractive. It tightens financial conditions for everyone, making it harder for companies and people to borrow money. It threatens to unwind decades of debt that was built on this foundation of free money from Japan. And maybe most importantly, it makes it more expensive for other governments, including the US government, to borrow money. If you take away just one single thing from all this, let it be this. The world can no longer pretend that borrowing from Japan is free. That core assumption, that pillar holding up so much of the global economy for so long, is officially on shaky ground. Which leaves us with one final and really crucial question. Everything that happens between now and that election on February 8th could set the course for global markets for the rest of the year. So, is the world's quietest market about to cause the most noise? Honestly, that's something no investor on Earth can afford to ignore right now.